Oh, thank you for joining me today. My name is Marcmontini. My company is the Montini and Company Tax Advisory Group. And on today's little mini webinar, we're going to be discussing mitigating or managing stock market risk. Real briefly about us, we are both a tax and financial planning firm. We're a one-stop shop for all your planning needs. I am a licensed fiduciary and an independent financial advisor. I've been in financial services now for almost 30 years. What we really specialize in as a company is we specialize in tax reduction strategies and possibly tax elimination strategies. We build long-term sustainable retirement income plans for all of our clients. We do manage assets and we do actual tax returns. Our returns start at $175. Now, in this webinar today, we're going to talk about why are we concerned about risk. We're going to talk about the different kinds of risks. But most importantly, we are going to be talking about the solutions to these risks. Okay, I can't expose the solution if we don't understand what the risk is. We're going to talk about tactical money management versus traditional buy and hold, and why that's an important method of mitigating risk. And then we'll talk about some of the alternatives that we have out there to also help us protect our assets. Now, why are we concerned with risk? Because running out of money is not an option. Okay, we no longer have time like we used to. Okay, and when we take too much risk, that very well could be detrimental to the supplemental income that we're getting for our retirement. Now, the first risk that I'm going to talk about here is called sequence of returns risk. And this is an interesting scenario because what you're looking at here on the chart is these two periods have the exact same annual returns. The difference is the annual returns are simply reversed. So you see the light blue starts at positive 26 and the dark blue ends in positive 26. So they're identical annual returns, just reversed. When there is no income taken, when it's just growth, the end result is identical. They both start and end in the exact same place. Now, when we introduce income to this scenario, now the sequences become a little bit more important. Okay, and it kind of breaks down to a lucky scenario and an unlucky scenario. With the lucky scenario, where we start off positive first, we get that supplemental income and the principal actually continues to grow. Where if we have the unlucky scenario where we start off negative, we end up dwindling the principal and ultimately running out of money. So the sequence of when you get positive returns and when you get negative returns really matter, especially when it comes to taking income. And we absolutely do not want luck to be a factor in our retirement. Now, the other thing about risk is it has a relationship with time. And so what we're looking at on this chart is if we have $100,000 and you lose 10%, okay, we now have $90,000. And we need to make 11.1% just to get back to even. Well, that's reasonable. Okay, we expect we're going to have a down year from time to time, and then you have the inevitable rebound year, and we get back to where we were. But what if it was something more dramatic? What if we lose 30%? Okay, your 100 grand is now worth 70, but we got to make 43% just to get back to even. Well, now time is a factor. How long does it take to make up 43% just to get back to where you were? So we want to pay attention to time and risk. The last is diversification. Okay, and maybe your portfolio looks like this. Maybe you've got accounts at multiple, big box brokerage companies or big insurance companies. What they're typically going to do in management of the asset is they're typically going to take a buy and hold approach. Okay, now buy and hold is also referred to as modern portfolio theory. And what modern portfolio theory states is that by investing in non-correlated assets, these are assets that kind of work on the inverse of each other. By investing in non-correlated assets and diversifying between high risk and low risk, over time, you can generate a reasonable return based on the amount of risk you're willing to take. Buy and hold works. Okay, modern portfolio theory works, but it needs time. Okay, over an extended period of time, it can be a good strategy. The problem is, as we've identified, we don't have time. Okay, we don't have the opportunity to lose a significant amount of money while we're getting ready or entering into retirement. So as a solution, okay, oh, and let me continue to talk about this. So let's say you are spread around amongst, the big players in the game, okay? You're probably much less diversified than you really think, because what these companies typically are going to do in this buy and hold approach is they're going to put you into a certain predetermined allocation, like a 60-40, 60 stocks, 40% bond allocation. And when you look at what actually you are invested in, the specific mutual funds and the specific ETFs that you have, you'll find that the holdings within those funds are all identical. They're all Alphabet. They're all Facebook. They're all Johnson & Johnson. They're all NVIDIA now, and so when you have multiple accounts out there, most likely the exact stocks and bonds that you're invested in are probably the same. So you have risk there that you're not as diversified as you may think that you are. Now, here's where we're getting into our solutions, okay? The first is going to be, in opposition to buy and hold, we like to take a tactical approach, okay? Tactical money management means action. Somebody's watching your money. Somebody is making proactive moves on a daily basis to invest based on what the economy dictates we should be invested in. Okay, you're not going to hear our portfolio manager say, "Oh, just write it out." That's not going to work in retirement. Okay, we need to be proactive. We need to see and follow the market trends. We need to see what the economic indicators are pushing us towards, and we need to invest based on what the economy dictates. The moral of the story with tactical money management is somebody's watching every single day. Here's a good example of what tactical money management means. On this chart here, we are looking at performance by asset class going back to 2008. Okay, at the top of the chart are the best performing asset classes, and at the bottom of the chart is the worst performing asset classes. So let's just focus on the purple box here because it kind of jumps out a little bit. Purple box would be emerging markets. Well, 2008, that was a horrible place to be. But 2009, it came roaring back. 2010, pretty good year. 2011, pretty bad year. 2012, back on top. 2013, bad year. And you can see all of these asset classes all fluctuate like this. So just taking a predetermined allocation and just writing it out isn't the best course of action for somebody entering or preparing to enter into retirement. We want to be tactical. We want somebody watching and saying, hey, emerging markets just had a really awful year, but it's trending back in the right direction. Or in making those proactive tactical moves. Okay, that is a big solution to a lot of risk. And that's not just accepting that the markets are going to have their ups and downs. Now, as an alternative, okay, I will utilize an annuity for a portion of some of my clients' money. Okay. There's a lot of annuities that are out there. Okay. And annuities, the most common complaint I hear about annuities is they are confusing. And I'm not going to dispute that. You'll see that in my next slide. But we don't want to discount annuities because they give us 100% guarantees against stock market losses. So when I'm building a plan for my clients, I will use an annuity for a portion of the money, okay? And I will use that as the foundation of our safety, that we know no matter what, the worst conversation I'm going to have with my clients and their annuity is, yeah, the stock market really tanked, but you made zero and you didn't lose a dime, okay? there are some tax benefits that annuities offer specifically for non-qualified money. Okay, non-qualified is money that you have already paid taxes on. For non-qualified money, that money will grow tax deferred, where if we just invested it in the market, that non-qualified money would generate a 1099 with capital gains taxes as well as dividends. So we do get a little bit of a tax break too with the annuity. When you're looking at an annuity, okay, and you're determining is an annuity right for you, always make sure you're buying that annuity for a purpose. Okay, I do not believe there are bad annuities out there, but I do believe there are bad uses of annuities out there. So make sure you have a very clear-cut goal. What is this annuity accomplishing for you? An example I would tell you is there are certain annuities that are built specifically for income. Okay, and those can be great annuities. You can get a bonus up front. They'll give you a guaranteed rate so that when you initiate the income benefit, there's going to be some guaranteed growth in there, and they're going to spit out an income stream for the rest of your life. That's not a bad product. But what if you don't necessarily need significant supplemental income? Maybe you're living on $4,000 a month, okay? And with Social Security between you and your spouse, Social Security is probably going to pick up the vast majority of that. So the supplemental income that we're going to be taking is going to be a relatively small percentage of your portfolio. So buying in and paying fees on an income generating annuity may not be your best choice. Okay, that may not be what's in your best interest. So make sure you have a clear-cut purpose as to why am I buying the annuity. Also, we have to find balance. The big negative associated with annuities, besides being a little confusing, is they're not as liquid as we'd like them to be. Okay, in order to get upside potential with no downside risk, the trade-off is liquidity. They're only going to allow you to take out typically up to 10% each year. And if we take out more than that 10%, we could incur a surrender charge. So that's why I say for a portion of your portfolio, an annuity may be a good place for you to go. The other money we want to make sure we keep in a liquid position, so that in the event that you need to get more money than what the annuity can generate for you, we've got a place where we can go where we're not going to have any surrender charges. Now, when it comes to annuities, again, there's lots of different types of annuities. The type that I typically will utilize in my practice is called a fixed index annuity. And what this means is your return is going to be based on an outside stock market index. Now, you don't own the index, so you don't bear any of the risk of that index. So that's why if the index were to go down and be negative, you would simply make zero, and you would not lose any of your principal, which includes any gains that you had made in previous years. Index annuities can be very complex, and that's why I use my little mosaic picture here of Abraham Lincoln. When you pull it up close and look at it and really get into the meat of the annuity, they can be very, very complex. But when you pull it back and look at it from more of a distance, the overall goals come out and start making a lot more sense. We're really trying to generate upside potential with no downside risk. Okay, now how we do that can get complicated. But at its core, that's what often we're looking at is, where can I get that upside and keep my money protected from true stock market risk? And that's what you get out of an index annuity. Now, if you want to know more about annuities, okay, I've got a 12-minute mini webinar dedicated strictly to annuities. And I talk about all the annuities, all the different kinds of annuities, all the good things about annuities, and all the bad things about annuities. So, keep your education going. Watch my 12-minute video. You can find it on my website. When it comes to managing risk and protecting the assets, I always like to take the advice of our good favorite Uncle Warren here. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Also, this stuff is complex, right? Figuring out how to retire, figuring out where your money's going to come from, how do you make it sustainable, what makes it sustainable, and how do you make sure it's coming out in the most tax efficient manner possible. Let me help you. Let me build you an income plan. This is a proprietary document that I created in conjunction with my CPAs. and you can see where your money's coming from. You know that it's sustainable, and you know it's being taken in the most tax efficient manner possible. Lastly here, again, don't do this on your own. Sign up for a free, no cost retirement evaluation. Let's see where you're at, right? And let me build that income plan for you. We take a very holistic approach to the type of financial planning that we do. We look at taxes. We're looking at mitigating risk. We're looking at how do we still grow the money, right? How do we still get a good, fair, competitive return on your retirement nest egg? So you can sign up for an appointment. If you go to my on this landing page, you'll sign up. It'll take you to my retirement evaluation form, and on there you can sign up for an appointment. We can do it via Zoom. We can do it in my office, whatever you're most comfortable with. Lastly here, if you like this content, you like the education, I've got a whole library of little mini webinars. So if you go to my website, montinico.com/webinars, you can see my entire library of covering all kind of different topics related to your eventual retirement. And then you can also see the questions that I have answered from my clients. My clients emailed me what their concerns were before they retired and what their concerns were after they retired. And I shot them on my wife's iPhone and answered them as frankly as I could. So I hope you enjoyed that. That's some of my favorite content that I've put out. With that, thank you very much. I hope you learned something here, and please sign yourself up for retirement evaluation and let me help you out.